The beginning of 2018, and especially February, has made investors much more aware of the real risk of the market. There was a complacency in 2017 with volatility being very low in the market, and 2017 has shown that you can have corrections which are very fast and very strong, and that volatility can go up very strongly also. So investors should have an holistic approach to risks. They shouldn't take only one measure. So volatility, the problem is that it doesn't say anything about the potential loss an investor can cope with. So we would recommend using other measures such as expected shortfall, and also other risks such as liquidity risk, fat tail risk, or skewness risk, which will give an overall view of the risk an investor is facing. We believe market stress event will become much more prevalent in the years to come because we're going from an environment of quantitative easing to an environment of quantitative tightening. This means that we will have bursts of volatility and sharp correction in markets from time to time. It means that investors will have to adapt their asset allocation to these new market conditions. I think asset allocation will be very different going forward than it has been in the last 10 years to be successful. Two different aspects that have to be taken into account. First of all is diversification. There will be a need to be diversified away from traditional asset class. Second aspect, which is very important, is dynamic allocation. There will be a need to hedge sometimes the portfolio when market will have performed quite strongly or that economical news will become less good. Alternative risk premia offers a real diversification to traditional asset class in a period where traditional asset class are quite expensive, such as equity and bond. Moreover, they offer an allocation in a liquid and cost-effective way to investors. We believe investors should continue to allocate in equity because we believe that we are in an environment of growth in terms of macroeconomic cycle. Nevertheless, it's true that valuations are quite high, so it's important that investors continue to invest in equities, but in a risk-managed way. Allocating in alternative asset classes will become more and more prevalent in the years to come because we need to diversify away from traditional asset class. The beauty with alternative investment is that you have different flavors in the same bucket. So you have the liquid alternative space, and there we recommend to invest in alternative risk premia because it's a liquid, cost-effective way to diversify from traditional asset class. And then there's the private equity or other private assets, which permit to invest in the real economy in a period where we are positive on growth, and therefore in an asset class that will boost the portfolio. I think in the past decade, simplicity was a lesson to success because in fact the more simple your asset allocation was, the better performance you have. Nothing has beaten a passive allocation with 60% bond and 40% equity that you had let live in your portfolio for years. Going forward, I think because we have liquidity tightening, because we have interest rate going up, because we have traditional asset class which are quite highly priced, there will be a need for much more dynamic and diversified allocation in new asset classes. The investment philosophy that will be important going forward is an investment philosophy which is nimble, diversified, with risk management at the center. So it's going from simple way of investing that have been very successful in the last decade in perhaps more sophisticated way of investing in markets that are becoming much more complex.